A single sentence, comprised of just 7 words, was all it took to send the global financial architecture into a state of absolute, unmitigated paralysis this afternoon. These words were not spoken by a radical insurgent or a fringe theorist, but by a man who has spent his entire professional life at the helm of the world's most sophisticated central banks. He knew exactly where the kill switch for the American economy was located, and today, he reached for it. I have spent my career reporting on the front lines of market volatility. I've seen currency collapses in emerging markets, the 2008 systemic freeze, and the brutal trade wars of the last decade. But I have never witnessed a spectacle quite like what unfolded today between two nations that have shared a border and a destiny for over a century. What began as a friction-filled dispute over continental energy exports has mutated into a financial Manhattan Project. The most terrifying part? Almost no one in Washington's intelligence community saw this coming, save for one man who had been quietly calibrating his defenses for months. This afternoon, the world watched as the United States government deployed its most lethal economic ordinance against a NATO ally, a Five Eyes partner, and its own largest trading companion. Within a matter of hours, Canada launched a counterstrike so precise and devastating that it has left every central bank governor on Earth asking a chilling question. If America can do this to Canada, who is safe? The answer to that question will likely dictate the flow of global capital for the next 50 years. The timeline of the rupture is precise. At 3:12 p.m. Eastern Standard Time, the White House issued a statement that effectively declared financial war. The president signed an executive mandate imposing immediate scorched earth restrictions on Canadian banking giants operating within the U.S. Specifically, the order terminates all correspondent banking relationships between the Big Six Canadian banks and their American counterparts, effective at the stroke of midnight. The White House justified this as a defense of national financial sovereignty, a retaliation for Canada's refusal to provide unconditional energy guarantees. The administration's gamble was simple. They believed that by cutting off Canada's access to the U.S. dollar clearing system, they could force a total capitulation within 48 hours. The American calculation failed to account for the man at the podium in Ottawa. At 5:08 p.m., Mark Carney, the Canadian Prime Minister and former governor of both the Bank of Canada and the Bank of England, stepped into the light. He didn't use a teleprompter. He simply looked into the lens and delivered the 7 words that shattered the bond market. Canada will now sell its US Treasury holdings. With that single declaration, Canada weaponized the one asset the US Treasury assumed was untouchable: its own debt. By threatening to liquidate over $300 billion in US government securities onto an already fragile open market, Canada moved to initiate the most significant financial escalation since World War II. Within minutes, currency desks in London and Tokyo were in full-blown crisis mode, and the risk-free status of American debt was called into question by the very people who hold it. To understand why Washington thought this would work, you have to look at the plumbing of the banks. The 6 largest Canadian institutions manage approximately $4.88 trillion in assets. One of these banks alone holds more American retail deposits than most mid-sized domestic banks. Starting at midnight, these institutions are legally barred from clearing U.S. dollars. For millions of ordinary Americans in New York, Florida, and the Carolinas, this is not an abstract policy, it is a personal catastrophe. Because their bank is Canadian-owned, their accounts are now effectively under a digital lock and key. Frozen liquidity. Millions will wake up tomorrow unable to withdraw cash or pay their mortgages. Systemic risk. The SEC has been directed to review all Canadian bank listings, potentially delisting them from the NYSE and NASDAQ. The enemy designation. This level of financial aggression is typically reserved for rogue states like North Korea or Iran. Using it against a treaty ally is a paradigm shift that signals the end of the special relationship. The White House assumed the pain would be asymmetric. They calculated that Canada, which clears $400 billion in USD transactions monthly, would collapse under the weight of its own isolation. They thought Carney would be on the phone begging for terms by Friday. They were wrong. The administration forgot that Mark Carney is not a career politician. He is the world's preeminent financial crisis manager. He is the only man to have run two different G7 central banks. He navigated the 2008 crash without a single Canadian bank failing, and he steered the UK through the post-Brexit panic. He understands the plumbing better than the people who signed the order. Carney's defense was twofold and surgical. 1. The multilateral swap lines. He revealed that Canada had already activated emergency liquidity agreements with the European Central Bank, the Bank of Japan, and the People's Bank of China. This allows Canadian banks to bypass the US dollar entirely, settling trade in euros, yen, and yuan. 2. The pension fund pivot. He instructed the Canada Pension Plan Investment Board, which manages over $500 billion, to begin a 90-day liquidation of its $319 billion US Treasury portfolio. By diversifying into gold and European bonds, Carney isn't just protecting Canada, he is showing the rest of the world the exit door from the dollar-dominated system. The market's verdict was swift and brutal. In less than 20 minutes, the US dollar index plunged 3.1%, its steepest one-day drop in recent memory. Treasury yields. The 10-year note spiked from 4.38% to nearly 5%. Gold surged $127 per ounce, hitting a record high as capital fled toward safety. For the average American family, these numbers translate to a sovereignty tax. Because mortgage rates are tied to the 10-year Treasury yield, the Carney Spike is expected to add roughly $340 per month to the average American mortgage payment. In an era of high inflation, this is the difference between a family keeping their home or entering foreclosure. This is the direct, tangible cost of using the financial system as a sledgehammer against a partner who knows how to swing back. As of tonight, a humanitarian crisis is brewing within the U.S. banking sector. Approximately $380 billion in American deposits are held in the Canadian branches currently under the freeze. The FDIC has yet to confirm if these deposits, frozen by an executive order rather than a bank failure, are even covered by federal insurance. State attorneys general along the eastern seaboard are already preparing lawsuits against the federal government, arguing that the president has no legal authority to freeze the solvent accounts of U.S. citizens over a foreign policy dispute. The political blowback in states like New Jersey and Florida, where Canadian banking footprints are massive, is expected to be unprecedented. The most long-term damage isn't the Treasury sale, it's the shattering of trust. The US dollar's status as the global reserve currency is not based on gold or oil. It is based on the belief that the US is a predictable, rule-abiding actor. When you treat Canada like an adversary, you tell every other nation, Japan, the UK, the Gulf states, that their dollar reserves are only safe as long as they agree with Washington's energy policy. Tonight, sources at the Bank for International Settlements indicate that at least 7 major central banks are discussing an accelerated diversification away from the dollar. If the world stops buying American debt to finance its $2 trillion annual deficit, the American century ends not with a bang, but with a massive spike in interest rates. We are now looking at 3 distinct futures for the North American economy. Scenario 1. The tactical retreat. The White House, facing domestic fury over frozen accounts, rescinds the order within 48 hours. However, the trust deficit is permanent. Canada keeps its non-dollar swap lines active, and the world begins a quiet, decade-long migration away from U.S. assets. Scenario 2. The war of attrition. Washington refuses to blink. Canada dumps $30 billion in treasuries every week. Mortgage rates cross 8.5%, the U.S. housing market collapses, and the Federal Reserve is forced to print trillions to buy the debt that Canada is discarding, triggering a new wave of hyperinflation. Scenario 3. The multipolar shift. The Canadian-led alternative clearing system becomes a permanent fixture. Global resource trade, oil, minerals, wheat, begins to settle in euros and yuan. The US dollar remains a major currency, but its global monopoly is broken, and the cost of American borrowing increases permanently. The era of American financial hegemony was built on the assumption that no one would dare to leave the system. Today, A central banker turned prime minister didn't just dare. He showed the world where the exit was located. The 7 words spoken this afternoon didn't just change the market, they changed the world.